First, my name is Luan. I'm the CEO and co-founder of a company called FinMkt. We provide point-of-sale technology for banks and non-bank lenders who want to enter healthcare, home improvement, point-of-sale. Our biggest client on the other side that is not a bank is Renewal by Andersen. So they chose us over staying with Green Sky, and we're proud of that partnership. So with that, my esteemed panel, if you could do some quick introductions, and then we'll kick off.
Glad to do it. Robert Savoie, I'm partner at McGlinchey Stafford. We're a law firm, does regulatory compliance advice and litigation for fintechs and financial institutions, and I'm the chair of our fintech practice.
All right. Good morning. I am Steve Bishop. I'm the chief operating officer for OMB Bank. We were previously Old Missouri Bank, but decided to move from that because Old in Missouri has some connotations with it. But so we are in Southwest Missouri. We're fast growing. I've been there 3 years. We've gone from $500 million to about $1.5 billion, and looking to roll out our banking as a strategy or service API rollout in Q1 of next year.
Good morning, Jesse Honigberg. I'm the EVP of Product and Platforms for Customers Bank, which is about a $22 billion bank headquartered in Philly and spend a lot of time in New York. Principally, I'm in charge of our third-party partnerships as well as building out our tech platforms and strategies. And I wish I had a shirt as cool as Steve's.
Hey, good morning, Armen Meyer, former head of policy and regulatory strategy at LendingClub, co-founder with some people in this room of the Great American Fintech Council, and now I get to be a fintech pontificator, and you have to suffer through it.
Thank you all. All right, so we're going to start off with Steve. So OMB has been a traditional community bank since 1999, but you recently decided to enter the interesting and scary place of banking as a service. So just talk to us a little bit about what drove that decision and kind of what you're experiencing in terms of success, and then kind of how you see the future for OMB.
Absolutely. So like I mentioned, I've been at the bank for a little over 3 years, and when I started, I'm not sure if we had even moving away from paper processes on our radar. Obviously, we've came a long ways, updated the whole tech stack, a very strong traditional ag commercial lending. But for me, it's about preservation, making sure that the bank is relevant in 5, 10, 20 years. I think there's going to be a lot of consolidation. AI is going to change it. But I can't just say, let's spend money for 20 years down the road. BaaS is a natural, I can sell it to my board that I have revenue, that I have this additional income, and it's a very natural vertical to our traditional business. So we've always excelled at lending and not at the rest of it. And so if we can take the customer service, the things that we do well on the lending side, and then move that into our bank as a service, I think it's just a natural fit, and it allows us. I'm not a traditional community banker because I wouldn't get to wear shirts like this if I were. Yeah, so I get to bring that different way of thinking to the bank and make the bank more of a fintech, and that's how I see us being relevant and seeing us succeed going into the future.
Awesome, thank you. So I think Jesse probably has some good advice for you, being one of the sort of
Tell you what not to do.
Some early entrant into banking as a service, and watching it evolve into a lot of different things. But if you could just sort of talk to your experience at Customers Bank, and then any advice you can give for banks who want to enter.
So I think that my career trajectory with banking as a service, certainly I'm managing that group at Customers right now, but I think prior to that, I joke that I blew up a startup for a couple of months in late 2022, and before that I was at Cross River, where I had the unfortunate benefit of meeting Phil and becoming friends with him. And I think that was really where I learned a lot of the backstory on the potential, but also the pitfalls of what you can do with banking as a service and the opportunity it can unlock for your business and candidly for your clients. But like anything else, if you run really fast into it, you're probably going to trip and fall. And that may be okay, right? You may be comfortable, your board and your leadership team might be comfortable with taking a couple slips. I would definitely make sure your regulators are comfortable with you taking a couple slips. But if you're not, I would say think about where you're actually accretive to what you're really good at as a bank. And then how do you expand upon that? And all banking as a service really is saying, how do we deliver our services in as streamlined and as effective a way as possible? And the people who are usually going to extract the most benefit from that are very tech forward, which naturally, turns out to be fintechs. But I think that what we're seeing and the lessons that I've learned is that banking as a service is no longer just fintechs. And the real opportunity is how do we take those rails and those capabilities that we've built for fintechs and expand them out to our commercial clients? How do we enable deep integrations with ERPs for building efficiencies and creating incredible stickiness to those relationships? And I think that's the 2.0, and a lot of people talk about embedded finance. I think that the evolution of banking as a service is into embedded finance, where it's just what we do.
Yeah, no, I couldn't agree more. In fact, I always thought, yes, it's nice to focus on fintechs, but how many fintechs are really going to be around and be successful? And there's definitely much more application outside and sort of normal corporate.
Yeah. And I think that the fascinating thing for me is I get articles every day on AI and ML and every acronym in the world, and all of them are predicated on system-to-system access to data and being able to be transformative based on a bunch of raw materials. And so if you never can generate the raw materials for your partners and for your clients, you're never going to be able to have them embrace that, and they'll likely end up going with someone who can. And so building a lot of, the tech term I use is primitives, right? So building the primitives for you to deliver these services, as a pretty long tail investment, but it will ultimately be transformative. And I think that's kind of what Steve is building at OMB is, how do we think about what we need to be in 5 years from now? How do we build those primitives around the banking as a service framework, understanding that it's not just about fintechs, it's going to be about payment transformation and beyond.
Yeah, I think you make a very good point, and that's, today we do community banking very well, but we have to become more of the technology. We have to have that competency to integrate with whatever the market needs, and so shifting from that, getting that skill of technology, that's absolutely what you have to work towards to be relevant and be successful.
So Armen, as one of the early fintechs, and congratulations for still being alive.
The IBM of fintechs, thank you.
Would love to hear, and then obviously LendingClub made the decision to acquire a bank versus, initially partner and then become a bank through Radius. So would love to hear kind of how that's going for you. And in full disclosure, I am on the bank, the board of directors of Grasshopper, where Mike Butler is the CEO. So
You're pumping me for information in front of everybody.
But would love to hear kind of how that is going in terms of your
Sure.
being a bank,
Well, Mike left us a great bank that we purchased, so thank you. And I'm sure he's going to do great things at Grasshopper as well.
Yes.
So LendingClub, the 101 on fintech partnerships, just like 3 sentences for people who are newer to this. So why was LendingClub a fintech partner and then decide to buy a bank? So you partner, why? Because the fintech brings technology, marketing skills, customer service, tech, underwriting technology, I meant to say there. And the bank brings, of course, risk management. The bank brings, and if you're a lender, which was our interest at the time, the bank brings the ability to lend on a national platform, one set of rules across 50 states, rather than 50 sets of rules for each of the 50 states. Which, of course, if you have to deal with that environment, you're impeding your scaling, you're impeding your tech investment, and you're creating operational and compliance risk. So that motivated us to go from fintech to bank about 4 years ago, and we bought Grasshopper. So we bought Radius Bank. You got me confused.
You can buy Grasshopper if you want.
Yeah, exactly. Oh, hey.
Two banks.
But over the past few years, it hasn't been LendingClub, obviously, only. So I see Savoie in the room. Others have also acquired banks. But I'm not sure that the move to become a bank by a fintech changes this conversation very much for a couple reasons. Reason number one, it's a different environment now in just 3 years. It's very different now. I mean, not just the change of administration, but from the events in the banking sector at the beginning of this year, you're not going to see this floodgate open of fintechs becoming banks. Most fintechs are going to have to partner. Two, there are just too many fintechs anyway. There are too many good banks in the space. There are too many good fintech banking partnerships. The number of banks in this country is going down, not up. So you're not going to see this world where suddenly all these fintechs are becoming banks. So I think that like the move we had for some fintechs becoming banks was more of a blip against the broader trend of actually a lot more partnerships. And from my view at LendingClub on what makes a successful partnership and part of my pontification, what might make a successful BaaS bank down the road, over at LendingClub, we looked at some banks to acquire, obviously, and we partnered with and looked at other banks to partner with. And I think in today's environment, especially with where the regulators are at, the number one thing that, and you guys won't call me crazy, I don't think, the number one thing that a BaaS bank needs to do is really embrace its regulator and communicate much more frequently and in much more depth than it has in the past. That is good for your fintech partner. I think gone are the days, which weren't widespread but existed in some pockets, that it was good for the fintech, good for the bank to not embrace the regulator. The fintechs wanted less regulation. They didn't want the bank to be a pain. That's totally flipped on its head to the extent it existed in some circles. Now it's you want your bank asking questions. The bank wants its fintech participating because the bank is held accountable so much more today than it was 5-10 years ago by the regulators. Yes, the regulators have put this like great bow around prior guidance from 2013, repackaged it here this year, but it's the same guidance, whether it's the FDIC, essentially the Fed or the OCC. Nothing's changed. What's changed is what's happening on the ground, and that's what you guys are probably feeling. That's what all the BaaS banks are feeling, and it's good for your fintech to know that you got it covered. You're not going anywhere. Your programs aren't getting impeded. So the successful BaaS bank, I think, embraces its regulator. And the second point I'll make here is a successful BaaS bank even thinks about, and some are doing this, even thinks about, if we're going to be held so accountable for all of our fintechs and their regulatory compliance, we can make the choice to put it on them and manage it. And you got a third-party vendor, you might have a fourth-party vendor, or we can bring a lot of the stuff that we are good at in-house. I mentioned LendingClub's partnership with WebBank in the beginning. They were good at the risk management and the compliance. They helped us become a bank. We needed that to become a bank eventually. And that dichotomy still stands. Let banks be banks, let fintechs be fintechs, and the bank can actually bring in more of these compliance services. Some are already doing AML and BSA for the fintechs, a very common need of almost all fintechs. What about fair lending? What about compliance testing? What about model risk management? These are things that the banks can begin to do more and more for the fintechs. And that way they can be held accountable to the regulators. And that might be what we see in the future. And I would, Phil mentioned new partnerships here at AFC this morning. I would encourage banks. You don't have to do it all yourself, actually. There are great reg techs out there. Phil mentioned one. Fair Play is another. That's been a long-time AFC member in the fair lending space. Banks can be the center, the hub, between reg technology and their own reg tech and their fintechs. And that might be a model in the future going forward.
Well, so as our in-house free legal advice provider here, Robert, and based on what Armen said, and now banks and fintechs obviously are embracing each other and finding ways to work together to lower costs, and we probably did that faster together than the regulators expected. So would just love to hear from you what and how state and federal regulators are dealing with this sort of quick marriage and these synergies that banks and fintechs are finding together. How are the regulators handling that?
Yeah, glad to do it. And with that intro, I'll say, these comments are not those of my firm or my clients, maybe not even my own, and certainly not legal advice. No, kidding on that last part. But it's really interesting. I mean, when we meet with a fintech that has an idea to go and do a fintech program, particularly a consumer lending fintech program, I usually suggest maybe you should try something a little less heavily regulated, like building a nuclear power plant, just to kind of set the stage for what's about to happen over the next couple of years. But the evolution of regulation has been really interesting. I mean, one of the things I love about McGlinchey is we have great depth and long-standing expertise, and I have colleagues that built out fintech bank programs in the 1980s, primarily for student lending. And so the firm has a lot of historical advice on that and a draw on that expertise. And so you saw focus at that time primarily on the banks, not as much on the non-bank parties that were involved in those types of programs. And then, starting in 2010-ish era, right, when some of those pioneers, initiated the sort of modern fintech bank program, you saw the regulatory climate shift, I think primarily on the state level, where some of the states began to kind of learn about what's going on, and they said, okay, I see this fintech, I see you're partnering with a bank, and I see what you're doing, and so what I'm going to do is go in and look at our laws and change them, right? And so one of the state agencies that every time they see an industry, they want to have a new license requirement and a new regulatory scheme. And if you sneeze near the state of Connecticut, you probably need a license. And so what they did is they went in and amended their laws, and they said, okay, we're going to regulate you if you're a conduit between a consumer and a bank. We're going to regulate you if you're a servicer and you're between the bank and when the payments come in. And so they went through and revamped their law, and they edited it a number of times, and a number of states started following suit. And so what happened was, in 2010, when you were looking at bank programs and trying to expand and say, okay, look, we know the federal laws that apply. We're going to provide TILA disclosures. We're going to provide all these things. And you generally understand the federal sort of apparatus that applies to a program. It was the state apparatus that gave a lot of uncertainty, right? Where states said, oh, I don't know what I think about this, and I don't know how I'm going to regulate this. And then the states sort of started to figure that out and shifted their laws to apply. And some are focused solely on substantive conduct. Some are focused on licensing and supervision. And I think what you've seen over the last 10 years or so is a trend where a few each year go in to regulate the program. And what's really been interesting is if you looked at a fintech in 2010 to 2012, you saw fairly low degree of state licensing regulation. If you look now, a fintech has about the same number of licenses as a non-bank lender, right? If you're just a non-bank finance company that's going to go out and make loans yourself, you have about the same number of licenses if you're partnering with a bank that is extending credit. And then on the federal level, Armen, I think your comment was right? Vendor management, third-party risk management. That's absolutely the focus. I think the banking agencies are looking at the programs and doing what they should be doing, right? Are these programs in compliance with law? Do the banks understand their vendor management obligations? And is everyone doing what they should be doing? And your comment about the days of the banks not policing as well as they could being gone. I agree, right? We used to, talk to clients and say, look, if you have a bank that'll kind of do what you want to do on your product, there's a pro and a con, right? The pro is they'll let you do what you want, and the con is they'll let you do what you want, right? And so when you deal with that, maybe you have more product flexibility early, but if your product's going to run into a buzzsaw 2 years later, right, and you're going to have a bunch of consent orders and remediation, that's not what you want. And at least the people we work with, they generally want to be in compliance from the get-go because that lets you operate. It primes you for success. So the federal agencies are continuing to sort of focus on those issues. I think what's been really interesting is the CFPB. You're talking about their supervision, examinations of non-bank financial services companies. Obviously, with their recent announcements, they're going to continue to expand that. And I think that is an interesting development that you talk about, 80s, 90s, 2000s. You didn't really have those federal agencies coming in and directly examining the fintech. And so I think that's going to be a big shift where now you have a lot more direct federal examinations, whereas the OCC and the FDIC's examinations, they're indirect, right? They're examinations of the banks and indirect regulation of a fintech partner through their dictating of what has to go on for a bank program. But now you have much more direct supervision on the federal level where they're going to make sure and police that all the federal requirements are being complied with, which I think is going to be really interesting to see over the next 5 to 10 years, but it's certainly not going away. So.
Yeah, agreed, and changing and evolving daily, which sort of brings me to our last question. And Peter, how are we doing on time? Okay, good. So banking as a service, obviously, if you Google it now, who knows what the definition is, right? And then I think for regulators especially, probably makes it even more complicated that you can either work directly with a bank or through an intermediary then to the bank, right? So I would just like to know if you could share with the group here, each of you could chime in, what are the pros and cons of each of those models, right? Working with an intermediary versus working directly with a bank. So, Steve, I don't know if you go first.
I think Jess and I have slightly differing views on this. For me, we're a smaller bank that's in the room, but we want to make sure that we stay relevant. And what separates us from a fintech or other businesses, we have a charter. So keeping that regulatory in mind, we have to preserve that lead with compliance as we go about it. Banks are notoriously for moving slowly, and in this regard, for us, we want to partner with the middleware. We want to ease into it, learn how that relationship works, learn from a player that's been there and facilitate it. And we're doing some things to safeguard it Our agreements are with the fintech on our paper, not the middleware paper, and then get this really confusing relationship of those folks. So for us, it's about taking a very methodical approach, using vendors. The middleware is, I look on it almost as like a core provider, where they have my data and process it, but I own that relationship with my end consumer, and just using that tech as enablement for my product. That's how I view the middleware. I also view it as something that I'm going to learn from, and then bring more of that in-house. I have somewhat of a tech background, but I always have to remember I'm a banker, so I can't create a dev shop. But I do want to have that competency to manage it, and so it's about building that competency to manage those vendors so that we can keep that charter, we can keep our relevance, and continue to go into the future. So now for the opposite side of middleware, Jesse.
So I think that your approach is right as you're getting started. There you go. That
So cute.
I know, right? I thought it was well done.
Old Missouri.
So I think my approach is somewhat cynical as usual, right? It's that if you're and I'm talking specifically like a treasury prime, like let's call it someone like that, right?
Yeah.
And that ultimately, what's their value creation, right? Their value creation is ease of entry, and I have one interface that I can connect you to many banks, and so they own the network. And so whenever you own the network, right, you have people on both sides of it, and whether it's regulatory arbitrage between the banks on the other side of the network, and well, I think it's great you guys write on your own paper, right? It may be you say no, and now it's super easy for someone to go to someone who will say yes, right? My thought is that, and the way I look at it is, I'd rather, as we kind of build deeper and more capable tech and candidly regulatory relations and risk and monitoring and all of the things that go along with it, is I want to make sure that my partner has as much skin in the game as I do. And so ultimately, if we boil it down, banking as a service is exactly that. You're turning a fintech into a bank. And that means that not any bank, you're turning them into your bank. And you're enabling them direct access to the Fed. You're enabling them access to use your ledger to store funds. You're trusting them to do a lot of really important, complex things that if they don't get it right, you're on the hook for. And that I think as you get bigger and more sophisticated partnerships, the amount of compliance, the amount of, candidly, visibility that you need becomes higher. If you have one small partnership or a handful of small partnerships, it's great. But like you're doing LendingClub type volume, right? You need a whole different level of capability and people. And the abstraction that a marketplace or whatever, a middleware puts in line, I think really removes some of the culpability from the fintech, and candidly, it kind of could result in some regulatory arbitrage. Now, I don't think it does many times, and I think that there's lots of good reasons why people use those services, and we think about Plaid as a great example of essentially a middleware that's been tremendously successful. But the real question is, Plaid is really taking your consumers for the most part and enabling them to do interesting things, whether it's IAV or other types of identity or funds movement. I think when we think about doing large-scale, complex money movement that you would do for commercial clients, or that you'd think about enabling full-blown programs, I get a little bit anxious about that. And it's not that it's wrong, it's that everything in moderation, and it might be the right tool for part of your journey. But I think if you were to take on a LendingClub size relationship, right, don't do, my opinion, again, all the disclaimers, I wouldn't recommend doing that at an abstraction, I'd say work directly with them. Know that you guys have just as much skin in the game for the delivery of that platform and that service, and that you feel comfortable making LendingClub an extension of your bank, right? They're a branch for all intents and purposes. And that's something that I think as you get deeper and deeper down the rabbit hole really becomes, in my opinion, more apparent.
I don't.
Oh, go ahead.
No, I don't disagree with you at all. I think as a newer entrant, there's speed to market and there's scalability, and I'm not going to start with a LendingClub. Like that's not going to be the first relationship.
Can we not use LendingClub? They're a bank.
And by the way, you don't really need them, right?
Correct. And I just said
Any other fintech than LendingClub.
Right.
Yeah, it's simple, straightforward, absolutely. Like that for me is like where I want to start, and then build from that. And that's like we're on a different part of the journey than you are, and so I think that's really we can both have the right answer.
Right, the tolls are the key, right? Like in any network, the tolls are the key to making sure there's balance, right? And so if there's the appropriate amount of tolls to enter on the market on the middleware side, I think that it works, right? Because then there's enough friction for them to leave. And so then it might be great, right? It might really deliver great speed to market. If those tolls are lopsided, I think then you potentially could have, value creation that's not necessarily aligned.
All right, since they're talking about you like you're not here,
Sorry.
we have 5 minutes left.
You're
So.
here.
I think I'm here. So Steve, I was going to do the guy in the middle who brings it together, but you preempted me, which I'm very upset about. But there is a comment to be made here. Like, is it just middleware that we should be talking about in terms of like the models of the future? Or is it middleware plus the core that the bank, you FinTech, not LendingClub, because LendingClub's a bank, but you FinTech will be partnering with? What does their core look like? So there's middleware that can be a constraint on the FinTech's activities. There's the bank's core that can be a constraint on the FinTech's activities. The data has to flow kind of perfectly for the FinTech to be nimble and for the FinTech to have full capabilities to do what it thinks it needs to do to be successful using its tech. So I imagine that if we were to go back to the first question of like, what are we seeing as good models? I mentioned 2 points, embrace your regulator, and maybe even banks provide regulatory technology. I think this could be the king of them, right? Well, you can't say that in DC. In DC, this is the third of them. But you got to bring the tech so that the FinTechs can do what they want to do. It's not just about regulation, which is important. It's about like capability. And that's how the techs will be techs. And the banks will be banks. So you guys would know it better than me, I think. But I think like we're going to see cores update. We're going to see middleware become a thing for some banks that are newer entrants. We're probably going to see middleware go away more and more as BaaS banks get bigger. And I agree with you, there will be consolidation. So middleware is not always going to be there. And bring it back to your regulatory point, and Rob, we got to get you in.
Rob,
we got to get you in. Bring it back to your.
That's okay.
Bring it back to your regulatory point. I mean, do you really want to be the fourth party to a regulator? Like, I mean, it's good for a while, but eventually your FinTech is going to grow up. And LendingClub grew up, and we didn't want to be a third party to a regulator anymore, so we bought a bank to become the party. If you're a fourth party, the middleware in between, that's going to create all sorts of new challenges on the regulatory side, in addition to the tech challenges that will emerge over time. But in the beginning, I want to agree fully with Steve.
Yeah, well, I mean, I remember watching a regulator give a presentation about FinTech, and they said, look, you can't just say that you're innovating and break the law. Right? You can't just say, I'm innovating and not follow what the laws are that apply, right? And it was sort of intended as a warning shot to the FinTech industry and all of that. But it also illustrates a different point, which is within a compliant framework, there's a lot of room to innovate, right? And so you set guardrails around programs, and I think this is part of the maturation of FinTech, right? This embracing of regulatory compliance is you're going to build a program, right? You're going to set guidelines, and then you have room to innovate, right? You talk about middleware and partners and different things, but you're able to build guardrails that say, look, this is what you have to do. This is how we ensure AML/BSA compliance, right? That we comply with our obligations, and you build that, and then you innovate, right? And I think the comments about scaling, right? I won't mention a specific company's name, but when you have high volume, right, of transactions, the federal agencies would say your expectations increase because the risk of harm goes up when you're dealing with 10,000 customers versus dealing with 10. Right? Because it's harder to remediate for 10,000 people than 10. And so you talk about creating your program in a way that is compliant in a structural basis, right? Also, scaling your compliance when you scale your business, which means you're scaling revenue, which means you can afford more compliance, right? And that's built right into the risk management guidelines is the relative risk of the program, and it's based on its size. The CFPB acknowledges that, at least facially, and then you build that, and then the rest is monitoring, right? That's where you talk about your middleware and your compliance is, well, what's actually happening? What's actually going on? And you can see the agencies, particularly in payments programs, focusing on ongoing monitoring, your expectations, how are you managing complaints, what's going on, and you've got to be able to show the story of we've built our compliant box, we've placed our programs within it, and not just that, right? We monitor that on an ongoing basis, and here's what we've done. We got a complaint on this, we got a complaint on that, and here's how we resolved them, and here's the changes that we made. And I think that's what regulators are looking for.
We'd be remiss if we didn't say in 15 minutes, there'll be a Senate banking hearing.
Yeah.
The major regulator is going to be in front of the Senate with the ghosts of SVB and other failed banks. The word fintech is going to come up. If you're playing bingo, fintech, third parties. In 15 minutes, let's see if we know what we're talking about. We'll find out in 15 minutes. Crypto, yeah, some crypto. But yeah, third parties are like getting up there.
No, I think that we're
We're gonna wrap it up.
sorry,
Otherwise,
one
I could be here all day.
final last point, right? Is all of this takes foresight, right? And it's really hard to have foresight. And so if you're going down this road, front load your investments for where you want to be. Don't think that you can add it incrementally as you get there. Building a framework that could support compliance, that can kind of deal with granularity around an omnibus structure, all this stuff that works with BaaS is really hard to retrofit. And so if you're going to go down the road, think about where you want to be in 2 years and make those investments today. Because while you may not fully use them for the first year, they'll pay tremendous dividends for where you're going.
Perfect. Well, on that note, thank you all. That was very informative, amazing, awesome panel. Thank you very much. Questions? Oh,
There we go.
great. I don't think the mic is on though, Peter. Anybody have any questions? Here we go.
For the bankers in the room, what are you guys worried about? What keeps you up at night?
What are we worried about? I mean, what aren't we worried about? I mean, what's the day? I mean,
Those crazy fintechs doing crazy things, I imagine.
I think I'm worried about the tail event, right? The thing that we think we controlled for, but just got around us, right? And while I know that's kind of like an impossibility, but one of the biggest lessons I've learned, from my time at Cross River and a couple of my colleagues from my time there are actually here today, is that regulators are really bad at remembering what they told you in the heat of like trying to solve a problem, and they're really good at reimagining the past. And so I think that, sorry, again, Jesse's opinion, not anybody else's. But I think that just be really thoughtful about what you're doing and make the right decisions, not ones that need context to explain them. And I think that you'll be fine, but that's really hard sometimes.
Lawyers describe that as if it's not in writing, it doesn't exist.
Yeah.
So.
And get to your regulator early. They shouldn't come in an exam and find out about 40 new partnerships. They shouldn't read the call report to see your deposits tripled or quadrupled. Like, these are easy conversations. They shouldn't read it in a press release. If you want to be a really good actor, and this is obviously not always possible, get your program audited before they even come in. And that way you've done the work for them and you've been able to mitigate things before they even walk in the door. Anyway.
For me, I think it's the unknown is always what I worry about, and with novel activities, and it's hard to find the two people that can define what banking as a service is with the same definition, or what a fintech is. And now the Fed's coming in with they're going to examine novel activities, and what the hell is a novel activity? I mean, so I think I don't know, and that's what probably keeps me up at night.
We'll find out in 10 minutes.
Exactly.
All right. On that note, we're out of here. Hope you guys enjoyed that. Thank you very much. Good job.